Alright guys, so this is going to be the video about options and how I pick my options and pretty much what exactly options are, like all that type of stuff. So we'll just get right into it. So first off, an option contract. What is it? So the simplest definition is going to be this. So you have a stock. We'll just say we have, what, AAL, right? And when you buy an option, you get a strike price. So the stock is going to be trading and you're going to have a strike price. So let's just say we have 1, 5, 10, 15, and 20. So what does that strike price mean? That means if you have a call, which we're going to talk about calls and then I'll explain puts afterwards. So if you buy a call and you buy it at a strike of 10, that means that you have the right to 100 shares at that strike price until that expiration date. So you can kind of think of it as like a coupon or something. So let's say AAL was trading at $10 when you bought the call, and you bought that call for $2, which is going to be $2 per share since it's 100 shares. And what that means is that when you look at this options chain, each of these prices it's saying that this is $1.15. You're paying that much for each share in that contract. So if you bought the 23 call for $1.29, you're using a $1.29 per share, and you have the right to those shares until that expiration date. And that's why options contracts are priced like this. And when you pay for it, this is going to be $115 because, again, it's 100 shares. So knowing that, if you bought this $10 call and you bought it for $2 a share, that gives you your break-even price, because if you're paying $2 a share and you have the shares at $10, that means your break-even is going to be the strike price plus what you paid for it. And for puts, it would be minus. So when you buy this call, your break-even is going to be at $12. So right here. And what break-even means is that if it were to expire at $12, you would then be break-even and you would not make or lose any money, because this would be worth $2 a share since you have the right to the shares at $10 and AAL goes to 12. Now this is worth $200 and it's called intrinsic value, because when this is $2 in the money, which means that the price is above your strike, you then have $2 per share in profit. And since you paid $2 per share, now you're break even. You don't lose anything. So if this expired today, right at $12, you'd be break even, meaning you would be able to sell it for the same price you paid for it, or you'd be able to execute the option, which we're not really going to get into that, but all that means is that you can buy the shares at $10, you can buy 100 shares at $10 and sell them at 12, which gives you the $2 profit, which gives you the intrinsic value. And this is going to be the easiest way of figuring out how options are priced and what's expensive and what is not. So hopefully that makes sense for you guys. And now knowing that, let's say we'll just give you an example of trading. So we'll go up to the charts now and we'll just go to AL. Why not? So now let me clear the chart. Sorry, it's lagging a little bit. So let's get something that's actually moving a bit. I think Oxygen was moving. So, sorry guys, I'm just trying to find something for you. Okay. So just hypothetically, let's say you're looking at the chart right here when it was 3-1, which you don't have to know the strat for this, but if you're looking at your entry price right here at 240, we'll just say 240 even. When that occurs, let's say that 240 call is trading at a price of $5, which would be $5 per share. Now your break even is going to be 245 exactly, right? So if your break even is 245 and you bought this call, let's say on a Monday, then before Friday comes, you have to be above that price in order to make money. And that doesn't mean that if it doesn't go to that price and it's like a Tuesday, you're not going to make money. That's where theta value and other things come in, which I'm actually just not going to talk about in this. If you want to see a video on that, I'll try and link one in the top right corner that talks more about the Greeks is what they're called. But just knowing this, if you buy the 240 call for $5, you then are paying $5 per share and your break even's 245. So if you were to enter this and your target's up here, how much money would you make? So the way that you can calculate how much the intrinsic value is, whatever the option is actually going to be worth on expiration, is you take your target and you subtract whatever the strike price is of your option. So if you had the 240 call for $5 and your target's 255, you would get 255 minus 240. So your options can be worth $15 a share because you have 100 shares at 240 and now it's trading at 255. So pretty simple, right? So that means that option would be worth 15 times 100. So that option would be worth $1,500. And on the options chain, it would look like what, 15, which this doesn't actually show that. Yeah, so like something like this, it'd look like 15. And there's obviously going to be a spread, but that's what it's actually going to be worth if you were to execute that. And you can see if you took that trade, now it goes up to 263, and that thing is worth $23 per share, or $2,300 from whatever you bought it from. And now that you know that, if you are trying to pick an option and your price target is not above your break-even price, then you know that option is too expensive, or that something's being priced in. It could be news or some type of event occurring or anything like that. And when the options are expensive like that, this is what I kind of think. So it's going to be a lot easier to make money on options that are cheaper, because those cheap options are going to become expensive, than it is to buy an expensive option and have that option become more expensive. And what I mean by that is, if you bought this 245 call or 240 call right here, if you bought that and you paid $20 a share, now if you come up to here, you're going to be underwater by what, $5 a share if that doesn't happen before Friday. So now knowing that, we can go and look at whatever setups we're going to look at going into the next day, which I can just we'll just load up a random scan here and look. So what, 2 up to 3 down week. Let's see. Look at these. So not that I'm going to be taking this trade, but let's say this was a setup on Monday and you're looking to hit 226 and your entry is going to be 230. So you want your strike price to be anywhere within this range. And why is that? That's because if you, let's say you just come and hit this target and your strike is 225 for a put, then that put, we know for a fact, is not going to be worth any money if that happens on expiration day. Because if you have the right to shares at $25 and it's trading at 27 for a put, remember, then you're going to be $2 out of the money, which means that your option is pretty much worth nothing intrinsically. And once again, intrinsic value is going to be your strike price compared to the price. So for calls, if you have the 230 call and it trades up to 233, then that's going to have an intrinsic value of 3.00 per share. And for puts, if you have the 230 put and it's trading at 228, that's going to have an intrinsic value of $2 per share, because it's just the difference between the strike and the current price of the stock. So knowing that, if you were to be looking at this option chain going into next week, which we can, we'll just look at the current one. So if you were to look at this going into like, let's say tomorrow, if you wanted to get short and try and hit that weekly magnitude. So we know our magnitudes could be around $26. So if we go and look at these puts, you're going to see the 227.5 put is trading 42 cents on the ask, which is what you're likely going to be paying. So if you're paying $42 for the right to 100 shares at this price, what's your break even going to be? For a put, your break even is going to be subtracting from the strike. So 227 minus whatever you paid, so 0.42. So your break even is going to be 226.58. And now that we know that, if we go and look at the chart, we have magnitude down to 226.28, or our target is 226.28. So if our target is 226.28 and we have the right to these shares at 227.5, then you would do 227.5 minus 226.28. So this is how much your option would be worth on expiration day if we are at that target for the week. So that'd be worth $1.22 per share. So now knowing that, you can look at the option price and say, okay, this is worth 42 cents a share, and we're expecting it to go to 122. So you do 122 divided by 0.42, and this is your percent return if you were to buy that as some type of entry and you were to hit that target. So now we know that that option, since that was like a 290% return, we know that option is not pricing it in. Now, let's say we're looking at it and this option was worth $200. Now that completely changes, because if this is $200, what your break even is going to be, since it's a put, you subtract. Your break even will be minus 2.00, since that would be what you pay for it. So your break even is 225.5. Now, if you go and look at the magnitude, we only expect it to go to 226.28. So what does that mean? That means that if we bought that and we hit our target, it would lose money. And that's going to be a pricey option that you do not want to trade just because of that. So hopefully that kind of clears some stuff up. And as for looking at leaps and stuff, that is going to be even better, because you can really figure out what's priced in if you're looking at if you're trying to trade a longer term type of chart. So if we go to something like ET, which was something I called out, you can see this. So if I go to my Twitter, I'll actually pull this up for you guys. We're going to pull up ET and then from at Alex's options. Now, so you can see this was posted February. And I said, I would like to call this one of the most amazing deals I've seen on an option ever. So sitting around $7 in said month. And the 2023 $12 call is only trading at 79 cents. So knowing that this call is trading at 79 cents, it's saying that by 2023, so in 2 years, this thing is not going to go over $80 above that $12 call, because your break even, again, for a call, it's going to be adding. So you add the 79 cents. So knowing we're buying the $12 call for that price, this is your break even price. And we have 2 years for that price to be hit or gone above. Now, if we go up here, you're going to see, if we go to what I was looking at previously, I believe is on the monthly for an entry, you're going to see this. I believe it was February. So it's right here. And we're trading at $6. So now, where's my target? Let's just say this was my target here for just for this year. And now for next year, we can go look at this. Let's say I expected it to go through these and go up to here to $19. So knowing that my target's $19, what is that call going to be worth? For a call, you do the current price minus your strike. So 1934 minus 12, because that's your strike. So now we expect this option to go to $734 within the next 2 years. And that's a $7.34 a share. And again, multiply it by 100, and that gives you whatever the dollar value is. So knowing that is going to be our profit, or what the option would actually be worth on expiration if we go up to and hit our target, we go 734, and then we divide it by whatever we paid. We'll just say 0.79. So now we know this is a nearly 1,000%er if we go and hit that target. And if we buy it right now and it goes up to there, this is how much we're going to make, not including theta and the other Greeks, which this is just how I look at it, because it's very, very simple and it makes the most sense to me. So other people are going to use Greeks and stuff. This is just the most simple, basic way that I do it, and a lot of other people like to look at it this way too after I talk to them about it. So now if we go and look at that option, you're going to see we're trading nearly $11, and that entry was, like 5 months ago? Now if we go to 2023's, let me see. I don't know exactly which one it was. Jan 2023. So you can see I even threw a screenshot out there. The $12 call is trading at 0.79 on the ask. Now if we go here again and we look at the, oh, oops, I was like, what the? Now if we go again, look at the $12 calls, look at what they're trading at now. So the reason that price goes up again is because of the Greeks, which those are part of, it's called, I believe, the Black-Scholes model is normally what's used to price options. And the way that works is that since market makers have to make this price something that's favorable for everyone, but something that's not going to screw them over, they have to use some type of model to price in the probability of whatever it is occurring, which is where we get our edge on the market, because we can see that and we can be like, that is not priced in, we're going to screw the market makers, right? So now that's trading at 146. And what does that mean? So if you're still holding this option, and I believe it was what, the $12 calls. Yeah, so trading $1.46. Now if we go look at this option, what is our break even if we were to buy that right now? That'd be $13.46. So the way that you can look at this now is if we were, the current price we're trading right now, 1087 and $1.46. So that break even, again, you just add the price for calls. So 146, 1346. So right now, if you were holding that position, you need to look at that price and say, I believe that it is going to be higher than this price right here at expiration. And if you look at that and you don't believe that at all, then that would be when you'd want to sell, because if you don't think it's going to go above this price, then you're holding for no reason. Hopefully that makes sense for you guys. But you can see how simple this is going to be to implement, and it should kind of clear up people who get confused with trading. And people are going to be like, well, for day trades, what's the deal then? So when you're day trading, it's going to be kind of the same thing. And let's say the options IV are very high, which the IV is going to be what makes them expensive and not worth holding to expiration, which is what we're kind of talking about here. So if we go to look at something like, let's just say Airbnb. So you can go look at the daily. You can see, so let's see this right here. So if, let's say you're looking to take this short tomorrow for a day trade and hit it down here. 144.46 down to here. Now, if we go and look at that options chain and look at this week's option, which is what I normally trade, now we can see what's priced in. So if you look at the current contract, that'll tell you what the priced in move is for the stock going into the end of the week. Because if you were to buy this right now and it didn't go past whatever this price was, then that was priced in, right? So hopefully that makes sense. Now, if we expect it to go to 141.59, you can use, if you're on Thinkorswim, you can use this theoretical price to just kind of figure out what the value would be at the end of the day tomorrow, which the way you do that is we'd be looking at it for the 10th. So on the 10th, if we dropped to our target, so I think it was about $4 to the downside, this is how much these options would then be worth, most likely. And this is using the, I believe, the Black-Scholes model to create those prices. So now looking at this, if we dropped $4 tomorrow, you're going to see this is worth $4.11, which makes sense because trading at 141 nearly, the 144 put is going to be $3 in the money. And the way you do that is just with puts, it's going to, again, going to be the strike, so 144 minus the current price, so 141. So you can see that's going to have an intrinsic value of $3, but it's going to be worth this much. And that's because you still have time left on the contract. And that time value increases and decreases based on how volatile or how much that stock moves. And that's what prices in stuff and makes it unfavorable to hold. So you'd see if we bought it at the current price and held it down to there, it'd be worth around double. So if you are okay with making double, then go for it. And if you're not, then you can move on to the next one and find something that's less priced in. And like, let's say you're looking at CLF today. So we're looking for a 3-2 going into today, which that occurred. And now you have a ton of pivots back to the upside. So let's say you're looking at these options last night and you're like, okay, I think this is going to go to at least $21, right? So then you'd go and look at the contracts, which we're going to use the opening prices since this day just closed. The way that you can do that is you go to customize and you add open. So it'll tell you the opening price of the option. So you're going to see this. So the 21 calls opened at a price of 35 cents. So if we believe we're going to 21 and those calls are priced at 35 cents, that means that you would not be above break even on expiration. And that means that unless it goes past that, you wouldn't make money if you were to swing the option, which you're going to look and see on the weekly. We do have this larger targets that we did hit. But now that you're looking at this, you know to go closer to the money if you're going to try and swing that potentially. And let's say you did think it was going to go to 72. Then now you know to look at this 21 call. And it's like, okay, if we're going to 22, that would be worth how much at expiration? That'd be worth 22 minus 21. So current price minus the strike price again. That'd be worth $1 at expiration. So if we think we're going to 22, that'd have an intrinsic value of 1.00, a dollar a share, so $100, and it's trading at 35 cents a share. So that's a good deal, right? And you can see these options, how much the percent changed, and we moved 14%. These went what, nearly 30 times, I believe, earlier in the day. This one was 3,600, but you can kind of see how you can figure out what is pricey and what isn't. And that's why a lot of people ask me, it's like, okay, well, how do you make money with options? It's like, well, we want to trade those moves that are going to be bigger than expected. So one of them that we took today, you're going to see, is going to be IQ. So this was our entry price. It gapped slightly above it, but if you're looking at the downtrend line, you could have just grabbed it right when it broke that and called it good, or got in afterwards off of a lower time frame. But I expected this to go up to 14.91. So looking at these options off the open, you're going to see the 14.5s were trading 23 cents at the opening price. So if I think we're going to go to 14.91, or around, we'll just say $15, and the 14.5s are trading at 23 cents, if we go to $15 minus that strike price, this is going to be worth 0.5 per share, since it's going to be $0.5 in the money. Now, if we look at the opening price, now we know to expect around 100% return if we go and hit that. And you can see the option, we closed just around our target. What's that trading at? Just right around where we expected it to be trading at. And that's because this isn't pricing in a lot of volatility, since this is worth what, 14.5? This is worth $38 intrinsic value, since 14.5, you do the current price minus 14.5. There's your intrinsic value, what it's actually worth right now. And then this is time value. So you can really see how this can be like powerful for figuring out what is going to be the large percent returns. And you can see today that went 260% with that gap up. So hopefully that can make sense for you guys. And I don't know if I can think of a trade we took previously. We can look at, what's it called? CLF. I believe it was on the daily chart. Yeah, this one. So if we go to the weekly, this was from the weekly list. And if I'll pull that up in a sec, you're going to see we have a 3, a 2 down, and then 2 up. We're going to target this right here. So what were those options pricing in at that time? Let me go and find that for you guys. This video is getting kind of long, so if you click off, I do not blame you. But we'll pull this up, and I believe it's what, CLF. Yeah, so you can see this. So this is on the lower time frame for the 322 week. So you can see our entry, 15.55. You can see right here, $15. I don't know if I might have had that wrong on my phone, but that was trading at 95 cents, 15.55, or 15.5 call. What am I doing? 15.5. I believe I put the strike price there. But anyways, so this was trading at $1, the 15.5 call. And on this weekly reversal, we expected it to go to $18. So now how do we figure out what that price is going to be? We do the target minus the strike price. So we're expecting this to go intrinsic value of 2.5 or $250. And if it is trading at, we'll just round up to $1, you're going to see this. So if it's going to go to 2.5 and we divide it by $1, it's going to be a 250% return. So that's something we definitely want to look at, since it's not pricing in this move. Now, if those 15.5s are trading at $4, that's something we don't want to really touch because it's completely priced in. And doing this for swing trades, really beneficial, unless if you get some like news or something, then I guess you're going to have the huge increase in value from all the other stuff. But on swing trades, this is super beneficial because if those options are not pricing it in, you can make a lot of money. And I don't know if I can find one where PayPal right here. So 514. You can see this, I believe. Yeah, this was on the 30-minute. Now, if we go back to 514 on PayPal, I'm just trying to drill a ton of examples into your guys' head so you can see exactly what we're looking for. So here's this chart we're looking at. I think it was something like that. I don't know. Don't want to draw it. Yeah. Okay. So it was drawn off that gap. So you can see we get the slightly higher high, and then our broadening formation target is to come 2-2 reversal here and then take it all the way down into this potentially. And you're going to see this huge gap down. So I believe it was the 242.5s. Let me see. I don't know if exactly I had the sorry, trying to look for this quick. Yeah, no, I cannot find the exact price of it, but I believe it was around, I don't know, I can check on my Twitter. I'm gonna have to edit this video a lot if I have time. So let's see this. There, okay, wait, no, that's the call. There we go. So here it is. So the 255 put was trading at 83 cents. So that gives us a break even of, since it's a put, you would subtract the price of it. So 255 minus 0.83. That gives us a break even of 254.17. So now, since we're entering it right here and we expect it to go to 245, what is that put going to be worth when we hit that magnitude? This is a great example of things being too cheap. So 255, and we go down to 245 at target. So the 255 put, and then minus the price since it's a put, that'd be worth $1,000 at target. And that was trading at how much? 83 cents a share. And we expect it to go $10 in the money. So that's going to be 1,000 divided by 83. That is a 1,200% return here. And now we gap down with our free runners. We open at 234. 255 minus 234. That puts $21 in the money. $21 in the money, also known as $2,100 from 83 cents, right? So 2100 divided by 83 gives you a 25 times return. So you can see when you find these opportunities, these are the ones that you really, really need to make sure that you get into. And I believe I did. I don't know exactly where this is. I don't know. I believe we have a quote tweet. Yeah, there it is. So you can see $83, $1,500 right at that gap down. And here, if we go to the price, you're going to see trading. It was about $1,700 with the spread, but $1,500 on the ask. 8.3K to $150,000. And we knew about that before that happened. So you can see how powerful this can be for your trading. And hopefully that explanation makes sense to most of you guys that have a big trouble with options trading, as buying cheap options, again, is going to be a lot easier than buying expensive options, because those cheap options are going to get expensive, and those expensive options getting more expensive, that's going to be a less probable outcome for you. So thank you for watching, and I hope to see you in the next video.